Welcome everyone to Vested Interest. This is Shane back again for another Stock Pick of the Day video. It is Tuesday, May 7th. We are going to take a look at one out of the financial sector. Franklin Templeton Investments here. Again, out of the financial sector. Let's jump right in. And if you are new to the channel, haven't done so, or would just like to help me out, it doesn't cost you a thing, but it really does help a small YouTube channel like mine with the YouTube algorithm. Helps to spread the videos. Hit that thumbs up button down below if you find any value in the content. Make sure you are subscribed to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Hit that notification bell so you're notified whenever we put out any new content. And drop a comment down below. Let me know what you think of the videos. Let me know if this one is in your portfolio. Is it one you're watching? Is it one you are avoiding altogether? Is it one you're selling maybe? This is the Vested Interest Stock Screener. This is how I look at a company on a high level to see if I'm interested. Just because it meets 5 of 8 or 6 of 9, and this is a financial company, so we will be looking at price to book. So we're looking for 6 of 9 in this case. Does not necessarily mean that I am investing in it. Just means that it might go on my watch list. Then I do more of a deep dive into the company, see how the financials are doing, and then decide a price I'm willing to pay by doing a discounted cash flow analysis. And then I wait for the price I'm willing to pay and the price of the stock to align and add it to the portfolio. And sometimes I also go back through my portfolio, look at the positions in the portfolio and make sure that they still meet this screener. And if they don't, then I do a little bit more of a deep dive to see what's going on with the company and perhaps even sell them and remove them from the portfolio. So you should not just be buying stocks in your portfolio and then forgetting about them. You should be on occasion going back in. I like to do it at least once a year, if not 2 or 3 times a year. Once a quarter preferably, and looking at the companies in my portfolio to make sure they still meet the criteria. They are still the good company from whenever I bought them. And if things change, like I said, it may be time to purge them from the portfolio and replace them with something else. So we're going to run through this stock screener. This is also how I set up the Stock Pick of the Day videos. So we're going to run through the screener. At the end, we'll see the results, and we'll see if this one, like I said, meets 5 of 8 or 6 of 9. Let's continue on. Now back to Franklin Templeton. If you want to know more about them, check them out at www.franklinresources.com. That's www.franklinresources.com. That is their homepage where I pulled this information from. And they are a brokerage account, right? They are a company was founded in 1947 in New York by Rupert H. Johnson Sr., who ran a successful retail brokerage firm, and that's what they are today, right? You can use them to invest for retirement, put some money in there for short-term investing. This is actually one near and dear to my heart. This was the first brokerage account that I opened. I dumped my money in whenever I first went into the military back in 2003, and then did so out of every paycheck for a while there. All through the military at least, and then for a few years after until I shifted into another brokerage account into Franklin Templeton. So this one is one that I have personally used. I do like their products. They have a lot of different ones out there. You can invest in small caps, large caps, mid caps, S&P 500. They have a lot of different products out there, similar to a Vanguard, not as big as a Vanguard or a Schwab, smaller than those two, but definitely just a brokerage account. That's what they do. He named the company for U.S. founding father Benjamin Franklin. I'm sure he was capitalizing on that name there because Franklin epitomized the ideas of frugality and prudence when it came to saving and investing. The company's first line of mutual funds, Franklin Custodian Funds, was a series of conservatively managed equity and bond funds designed to appeal to most investors, right? So they offer a lot of different type of funds, bond funds, stock funds, like I said, different categories of them with different fees. So just like any other fund that you might invest into, make sure you're paying the lowest fees possible, and you should not be paying to buy individual stocks anymore. Most brokerages don't charge you for that, though back in 2003 this was one that still did. Again, www.franklinresources.com. That is their homepage if you want to know more about them. And you should, if you are interested in investing in an individual stock, you should definitely start out knowing what the company does. How do they produce their revenue? Are they growing over time? Now, the reason we're taking a look at them, down 0.51% on the day. We are talking about Franklin Resources, Inc., ticker BEN, out of the financial sector. Closed today at $23.30. 52-week range as low as $21.88, as high as $30.32. Definitely closer to their 52-week low than their 52-week high, and they are within 15% of their 52-week low here. Their 15% of their 52-week low would actually be $25.16, so they're well below that. Market cap of 12.26 billion. So again, they are not as large as like a Vanguard fund or a Schwab fund. They are a smaller brokerage firm, but that's what they are. Beta of 1.42. They are more volatile than the overall market, and you can see that volatility here in the chart, even though that's just a one-day chart. Obviously, they've been pretty volatile for a while. Price to earnings PE ratio is $13.47 per share. But again, for these type of companies, we should be looking at price to book for a financial company. So let's jump over and look at price to book real quick. Price to book here, you can see their current is 0.96, so they are just slightly below 1. 1 typically being fair value, anything above 1 being overvalued, anything under 1 being undervalued. So this one right now is slightly undervalued, at least according to price to book. And you can see here throughout 2023, they were just over 1, 1.2, as low as 1.02 there back in September. So this is the cheapest they've been in a while. Let's jump back over to EPS, $1.73 per share. Earnings date July 26th through the 30th. If you're interested in that, tune back in July. Forward dividend is $1.24. Paid out on the year. They are quarterly payers, so divide by 4, though we'll see that here in a minute. Very high starting dividend yield on this one right now, 5.29%. Ex-dividend date, March 27th. Looks like they paid out April 12th. And one-year target estimate, at least according to Yahoo Finance, $25.52. So they see some slight upside from where it currently sits. And I'm not affiliated with Yahoo Finance. This is just one of the sources that I like to go to. You pick any sources that you like. Just don't blindly follow one. Make sure you're looking at 2, if not 3 sources to make sure the information you're getting is accurate and up to date. All right, if you were to go to Yahoo Finance, there'd be a lot of tabs over here on the side. You can look at analytics. You can look at statistics, financials. We're going to look at statistics. We're going to go down to dividends and split. That's where you also found the price to book under statistics. Go down to dividends and splits. We're going to take a look at dividend yield theory, see if it's potentially undervalued. To do that, we look at the 5-year dividend yield average of 4.32%. So they have a high dividend yield typically at 4.32%, but currently it is well above that at 5.29%. So according to dividend yield theory, they are potentially undervalued. According to price to book, they are slightly undervalued. So 2 good signs that they may be showing some undervaluation right now, but there may be a reason. So again, you want to do more of a deep dive. Are they, is Vanguard and Schwab taking, and maybe BlackRock taking more of their customers away? Maybe they aren't growing as fast, right? You really want to look at the financials and see what's going on there. There may be a reason why they're down. Now, payout ratio, I like 75% or lower. They're at 70.52%, so they are getting on the high side, but still under that 75% I look for. Now, we're going to take a look at financials. We're going to go back to 2020 here. We're going to look at free cash flow. We want growing free cash flow over time. Dividends are paid out of free cash flow, and typically if a company has growing free cash flow, they have growing dividends to match. Going back to 2020 here, you can see $979 million. 2021, jump up to $1.1 billion. 2022, up to $1.8 billion. Very good year. Big drop in 2023, down to $989 billion. Overall, you can see here they are repurchasing some of their shares. So going back to 2020, you can see $218 million in share repurchases compared to 2023, $256. So overall, I would say growing free cash flow, though not a lot in these 2 years here. It was nice growth here, but then this drop back, and I don't think this repurchase of shares accounts for, right, 180 to 256, though it's higher. I don't think it accounts for that drop. That's a significantly almost cut in half there. So for whatever reason, very good year in 2022, down year in 2023. But overall, from 2020, they are up over the last 3 years, and this kind of is a big anomaly, and hopefully they get back on track in 2024. I'm going to call it growing free cash flow, though it is minuscule. It's not a lot, right? I'd like to see better. I do like that they're repurchasing their own shares consistently every year. That is nice to see, taking some of those shares out of the market. And we're going to jump over to stackanalysis.com. This is another site that I like. Again, not affiliated, just one of the sources, and make sure you're looking at more than one to make sure the information you're getting is accurate and up to date. Now, they have 10 analysts that have taken a look at this. They call it a consensus hold, and it's actually closer to a sell. It's right on the edge there. If you go to the site, you can see out of these 10 analysts who calls it a strong sell, hold, buy, or strong buy. I'm assuming most are calling it a hold or a sell, maybe even some strong sell here based on where it's at. But right now, they're calling it a consensus hold out of the 10 analysts. They have a low estimate of $24. It currently sits lower than that. So if it came back up to their lowest estimate, that would be a 3% increase from where it currently sits. Average estimate of $27.33, which would be a 17.3%. And that's a little higher than what Yahoo Finance had. Low is pretty much in line. I think Yahoo Finance had it at some 25. So they're low on average. Right in between there is where Yahoo Finance had it. and their high estimate of $32 would be a 37.34% increase. All the while, you could collect that 5.3% dividend yield. Now we're going to jump into statistics here. We're going to look at return on equity and return on invested capital. I like 10% or better for both. Return on equity is a little low, 7.4%. Though if you were to compare them to other companies in their sector, this is not crazy low. Just these companies, for whatever reason, their return on equity and return on invested capital is typically low, though their margins are crazy high. I know I don't show that on here, but if you were to go look at them, their margins are extremely high. But does not meet the 10% I'm looking for there. Same thing with return on invested capital, 2.86%, lower than what I'd like. I like 10% or better. Now, their EPS growth forecast at 15.59% is higher than the 5% forecast that I look for, and 3 times as high. So very nice there, though I don't like that their revenue growth is negative, right? They're expecting revenue growth. So again, you might have companies like Vanguard, Schwab, BlackRock, a lot of banks now offer brokerages, so they might be seeing some impacts from that, as well as the market's been pretty crazy, ups and downs. So you might have some people sitting on the sidelines with some cash, not jumping in here, waiting for more of a pullback. There is some of that going on as well. Let's continue on and look at the dividend and wrap this one up. So again, quarterly payer, 70.86% payout ratio, under the 75% I like, though it is getting up there. Dividend growth of 3.39%, not, super low, but not double digits like I'd like to see, or even high single digits, 7-8% would be nice. But they are growing their dividend, and with such a high dividend to start with at 5.3%, I could live with slow dividend growth. Growth to 44 years, so consistent growth over time. Very nice to see. Now, their buyback yield is not going as swimmingly as you'd like it to be, negative 5.24%. We'd like that to be a positive number, and their shareholder yield is very low at 0.07%. You're basically buying this for the dividend and treating it as a bond with some growth and upside potential. Now, they do pay out January, April, July, October, which is nice. Not a lot of companies pay out on that January schedule here. Going back to 2021, they were paying 28 cents. Raised it up December 2021 to 29 cents. December 2022 raised it up to 30 cents. And January here, most recent raise, January 2024, up to 31 cents. So I would anticipate another raise either in December of 2024 or January of 2025 to maintain this slight dividend growth. And it looks like pretty consistently is about a penny, right? Penny each time. So you're not getting a lot of growth, but you are getting some growth, but you're starting out with a high dividend yield on this one. Again, I would treat a company like this similar to how I treat Verizon, as a type of bond with a very high dividend yield with some potential upside in the future, right? That's how I treat a company like this. And as you can see, we went through the business, so understand the business, check. Growing free cash flow, though it is small, I will say check. Growing dividend, even if you wanted to take that one away and say no, that's fine. Growing dividend, yes, that's a check. Dividend payout ratio of 75% or less, it was at 70, so just below that. Check valuation based on dividend yield theory, yes, it's potentially undervalued with a nice margin of safety, at least according to dividend yield theory. Buy below a current cost basis or within 50% of its 52-week low. Yep, it's around $23 per share. Its 52-week low would be $25.16. Now, it does not meet the ROIC and ROE requirement of 10% or better, though it might be in line with its industry average, but I did not look at that. So if you compare it to some companies like BlackRock, like Vanguard, like Schwab, you might be able to see what theirs is. Even Prudential would be a good one, and see how they compare as far as ROIC and ROE. But I'm leaving it as not a check because it doesn't meet it here in the high level review we're doing. Earnings per share growth equal to or greater than the industry average. They had 15%, so I'm checked there. And it is slightly, just ever so slightly below 1 price to book. I think it was 0.96 on that one. So overall, 8 of 9. So this would go into the watch list for me, and then I'd do more of a deep dive into the financials. I'm not necessarily looking to add anything to the financials, but it is an interesting one. I may do some more research on this one and go ahead and add it to my watch list and see what's going on with the company. I do like the high dividend yield. My portfolio overall dividend yield is 4.5%, so it would be a little boost in dividend yield to the portfolio. And I think right now I only have a couple companies in the financial sector, though, again, I'd need to do more research on the company, but it at least meets the initial screener. Well, that is it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. And drop a comment down below. Let me know what you think of Ben, right? Franklin Templeton Investments. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company like Franklin Templeton you'd like me to cover in the Stock Pick of the Day series, go ahead and drop it down below in the comment section, and I will add it to the list and work it in on a day it pulls back. Still looking to do Visa. Visa was just up today, so that's the only reason we didn't do that one. Well, on to the next one. I really appreciate you stopping by. We'll see you in the next one. This is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Again, thanks for stopping by. Hope you have a great week, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing for educational and entertainment purposes. Investing involves risk and management money. You should never invest any amount not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice counsel of a certified financial advisor.